Ready to elevate your credit understanding and score? With insider tips and a plan, you can take action to improving your score, which can save thousands in unnecessary finance charges. Let's tackle today's topic with your coach, Credit Christy.
Hey friends, it's Christy, your credit coach. Thank you so much for joining me for another episode. So this time around, I was really struggling with some headlines and topics, thinking what would be important to bring to you for this episode. And it's mid-August at the time of this recording, 2025. And I know that millions of people are just drowning in debt right now. Millions of people also have a tremendous amount of equity in their home. But unless you can access it, it doesn't really help you. It reminds me of a situation with a past client I was just speaking to a few days ago. Unfortunately, she had a surgery and she didn't have any paid time off. And then that surgery was followed up with another surgery. So she was out of work for weeks and weeks. And unfortunately, that put her in a position where her family was living off of credit cards. They're at risk of their mortgage payment not being paid on time. And because of the extra utilization on the credit cards, her credit score is now showing up at a very low 600. So what does that mean in the purpose of this story? She has a ton of equity in her home, and it's going to be very, very challenging to access because she doesn't have the credit score that most lenders want to see you have. Especially when it comes time for a home equity line of credit, it's usually a 640 or higher. But 604 is not going to cut this for her. She just is in a tough place at the moment. So let's talk about household debt at the moment. I pulled some headlines, and the total household debt climbed $185 billion in the second quarter of this year. And I know it's really hard to conceptualize billions, trillions, all of that, but we've reached an all-time high of $18.39 trillion, approximately half of the national debt. When it comes to credit cards, credit card balances or debt is up $27 billion, auto loans up $13 billion, student loans are up $7 billion. And home equity lines of credit, there is an estimated $411 billion out in home equity, according to the Federal Reserve Bank of New York. So what does this mean? Well, delinquencies are elevated at the moment. Approximately 4.4% of all household debt is delinquent. That's a pretty substantial percentage. And now let's talk about student loan delinquency. Student loans came back into repayment 4, 5, 6 months ago for most people, unless you're in a position where maybe you're still in school, so these student loans are deferred. But millions of households are now in a position where their student loan debt needs to be in repayment status. Well, approximately 10.2% are more than 90 days overdue. And if you have 90 days late on your credit, chances are your credit scores are getting slaughtered. So I would encourage you, look at your credit report. You can go to annualcreditreport.com, or if you're signed up with, say, Equifax, Credit Karma, something like that, make sure you don't have late student loan payments reporting. So let's talk about credit card APRs for just a moment. Next month, September 2025, the Fed is scheduled to meet. And when they meet this time, they are anticipating reducing the Fed funds rate. This will be the first time in a long time, many, many months, that the Fed funds rate will be reduced. They just met in July and kept it exactly where it was. And there are some advisories out there suggesting that the Fed funds rate may be decreased by 0.5%. So what does that mean? The Fed funds rate and the prime index rate run in tandem. So when the Fed funds rate gets cut by 0.5%, the prime index rate will also be reduced by 0.5%. And the prime index rate is what credit card APRs are set off of and home equity lines of credit. So hold tight. What should happen here shortly is your credit card APRs and home equity lines should come down by 0.5% if the Fed reduces their interest rate next month by 0.5%. Now keep in mind, your creditors usually don't have that go into effect until at least 45 days after. So you should be a couple months away from, God willing, fingers crossed, a slight interest rate reduction, which means you keep up those payments and then more of your payment will go towards principal reduction than it will to the interest that it's been going to with the higher interest rates. Low and middle income Americans are just piling on debt and pulling back spending as much as possible, while wealthier individuals, according to a couple of articles out there, continue splurging. So the wealthier portion of our society is keeping the economy going. So thank you to the rich friends out there. But for the rest of us, you're probably tightening up the bootstraps, trying to figure out where you can cut so that you can start eliminating some debt and getting out from underneath this. So financial anxiety is on the rise. Some of these headlines are suggesting that people are feeling really anxious about credit card debt. It's taking a very deep mental toll, and 42% in this study had said that they're very anxious about credit card balances and that debt taking a mental toll, but only 21% are actually taking action or has taken action in the last 6 months. Another headline stated that 26% of Americans admit to spending more than what they earn. And friends, that's up from about 18% in previous years. Now we're at 26%. So when you are spending more than you are earning, you are digging a deeper hole, getting into debt, finding yourself getting buried under more payments. And that's what brings us to our next headline. A whopping 63% of people feel stressed out about finances. And approximately 35% could not handle a $2,000 emergency. We know that. We've heard that stat before. Buy now, pay later, those types of lending, my goodness, we're up to about 25% of those users of buy now, pay later, they're using it for groceries. It's not just hey, I want to buy a new TV, let's go ahead and spread that $500 cost over 6 months. No, they're relying on it for groceries. So that's saying they don't have enough money in the bank right now to pay for it, or maybe their credit cards are all maxed and they can't put groceries on credit cards. Buy now, pay later could potentially really bite you in the butt. Another headline had said that roughly 41% of buy now, pay later users were delinquent in the last year. Most were just days late, but late still comes with a late fee and then high APRs attached to that. Catch that again. Buy now, pay later users, about 41% were delinquent last year. So that's how these companies make money. They might spread it out over 4 payments or 6 months or something along those lines for no charge, quote unquote, no charge. But if you're late, now they start adding on pretty high and hefty APRs and interest fees and late fees, and that's how they make their money. So let's keep our eyes open to see if the Fed will cut their rate by 50 basis points or 0.5% when they meet in September. If so, we can feel a little relief in the APRs on credit cards and the interest rates on home equity lines. So those people who have home equity lines of credit to the tune of $411 billion across this country will finally feel a little bit of relief. So debt has its own vibe, and right now that vibe is messy. $18.39 trillion in debt. It feels like most people around me are just drowning in student loans and credit cards and car payments that are quite hefty. So here's what I want to share with you. If you own a home and you have a lot of equity, you could tap into that with a home equity line of credit, which would be a much easier and lower payment and interest rate than those high APR credit cards. I've also helped many, many people sell their current home, reconfigure their finances, either through a refinance and paying off that high APR debt and eliminating thousands of dollars of payments every single month, freeing up some cash flow and just bringing in some breathing room. And some of my first-time home buyers are saying, hey, my quality of life is being jeopardized right now. And I need to get out of this debt. I need to get out of this first home and into a better sized home for my family to where we're at right now. I've got to relinquish that 3% interest rate and grab on to what's current. But here's the deal. We can take the proceeds from that sale of the home, pay off auto loans, credit cards, student loans, personal loans, buy now, pay later loans. And although the interest rate is higher now than it has been in the last almost 5 years, we could free up some cash flow from getting you out from underneath all of that consumer debt, reposition you into your next home. And although your housing payment will be higher, the goal is to eliminate that consumer debt that brings you that comfort, that ease of managing your debt in a more practical way. I want to say thank you so much for joining me for this episode. And I have great news for my friends and listeners out there. I have a book coming out in September. It'll be available on Amazon and it's called Peopling. And I look forward to sharing more about that in a coming episode where we will dive into the heart behind the book, Peopling. Thanks so much for joining me. And until next time, my friends, stay well.
Subscribe now and share with a friend to stay in the loop for new credit content and insider tips to maximize your credit knowledge. And follow Credit Christie on Instagram.